Welcome to the G360 Wealth Podcast. Today, I'm excited to be joined by Jeff Krueger. Jeff is a partner at Seaport Financial Partners. He is a CPA and additionally a certified financial planner practitioner. Jeff is not only a trusted advisor to many of our clients, he's also a great friend and tax mentor to me. Jeff, welcome to the show.
Well, welcome. Thanks for having me, Sam.
Jeff, it's Friday. I got my cool guy hoodie on. You know, that's the trend. So I thought I'd show up casual to the tax podcast.
I love it. I love it. Hey, I'm all for that.
So Jeff, I thought I'd start off the episode by sharing a great story of how we actually got connected, because I was reminiscing with a client a couple weeks ago. I thought it was so great. So, as everybody starts out, we all have a lot of clients now, but there's a time where we didn't have so many clients, and it was really a fight to build our businesses and build our practices. And I met a really, really, great mutual client of ours now. But as it so happened, we were doing some prospecting on LinkedIn, and this particular client said, "Hey, look, I get these messages all the time. I've got this tax problem." This was like Friday morning, and if you can figure out this tax problem by Monday, I'll move half of my Morgan Stanley portfolio to me. So at the time, I didn't really have many clients. So I had the full day to try and figure it out. So I called one of my really good friends, a close friend of yours, Jeff Corey, another wealth manager, highly talented wealth manager, very good friend. And I said, "Jeff, I've got this problem. Like, what's the answer?" He was like, "I don't know, but I know JK knows." And sure enough, I phoned you up, introduced myself, and you sent me a full-length email that you allowed me to plagiarize your sophisticated content of split filing, ISOs, and non-quals. And I landed the client, and that was kind of the start of our relationship. So this is my formal thank you for that. I'm not sure if you recall that, but that's how we kind of got on this journey. And one of the really exciting things to me to really focus on, a lot of our practice are made up of business owners, but also corporate executives who have concentrated stock issues. So today, for our listeners out there, we're going to be talking about the fun stuff: non-quals, ISOs, AMT, RSUs, and 1202 stock. But with that being said, Jeff, tell us about yourself, Seaport Partners. I'd love to just kind of hear about what you're doing right now. Obviously, it's February 13th. It's a 3-day weekend. I'm not sure if CPAs get 3-day weekends right when everyone starts uploading their tax documents, but love to just learn about you.
Yeah, sure. Well, before I get into it, I'm going to tell my own. I'll make this a love fest. So I'm going to tell my own Sam Diarbakerly story. Okay. So for those who work with Sam, I mean, Sam is really on the cutting edge of just like everything that's going on in investments. So I think it must have been like 4 years ago. I had a big client. So just like I helped Sam helps us. Big client. They had a very concentrated position. And I mean, Sam was just introducing us to this long, short tax loss harvesting. I mean, everybody's doing tax loss harvesting nowadays kind of thing. But this was like very early stages, 2021, 2022, something like that. We were talking about this long, short strategy that was kind of new that he knew about. We were talking about variable prepaid forwards. Again, we're getting like pretty tax technical here, other option strategies. So, for those who are looking for a financial advisor, that's not just going to be like, oh, you get into this model portfolio, who kind of, just very personalized approach and just, I mean, fascinating stuff that we were able to kind of like leverage that into a whole bunch of different clients and stuff like that. So, if you're thanking me, I very much thank Sam. And again, can't say enough good things about him and his practice. So with that said, for Seaport, so what we do at Seaport, we actually, we're probably a little unique in that we focus on the individual and then their related entities. And I say it like that just because a lot of times business owners are a huge part of accounting firms, right? But we actually want the individual and then their related entities. So what is that? That's more of like trusts, estates, private foundations, charitable vehicles, different things like that. Do we do businesses? Of course, right? But really, we want to focus on the individual side. And why that is because, maybe I'll call it two pillars of ours, right? Like one is proactiveness and planning. And and it seems obvious, right? It's like, well, shouldn't every accountant do it? And I think for whatever reason, accountants are just very reactive. And clients too, because again, this is a two-way street, right? And again, so we really want to stress with our clients, like, hey, the more we know about things before they're happening, the more we can provide value, the more we can, just help them see around corners, kind of thing. So that's a big proponent of ours, and we'll get into some of the different things that we do to encourage that with clients. The other thing we do, the other pillar, is just working with other professionals. So I know I just told that story about Sam, but it's so key that we say tax touches everything. It touches your income and retirement and estate planning and insurance and risk and all that different entity structures. What are we doing? So all that stuff just has a tax feel to it, maybe I'll say. So again, like, we're by no means expert in every single area, right? So we just want to work with the other, who is that? The financial advisors like Sam, right? Like the estate attorneys. Again, we're going to be talking about equity here. So maybe there's an equity director at a company, or maybe it's just the CFO, CEO, general counsel who kind of handles, equity awards, 409A valuations, M&A activity. And again, we'll get into what all these mean. But again, by allowing us to kind of collaborate, we feel like it gets everybody rowing in the same direction. So that's kind of what we're trying to do here at Seaport, and what we've been doing now for granted it's been almost 12 years now, and I think it's really resonated with clients and the like.
Jeff, how did you get to this really well-oiled machine and this prominent client list that you have of, really well-known business owners and executives? What was your like, hey, I think that individual tax is kind of broken, right? Like you have, it's funny, clients will come to us all the time. They're like, oh, do you have somebody who can do my return for $400? I'm like, no, that doesn't exist. Use TurboTax. Like if you have a simple return, use TurboTax. But the clients that need complexity and counsel and that proactive advice, how did you Seaport, you and your partners find and fine tune what you do now, like with the proactive quarterly emails, with the explanations for what's driving the returns? Was that just kind of, a think tank amongst you and your partners, or was that you took something away from a prior firm?
Yeah, it's a great question. So me and the founding partners, we all came from one of the big four firms, and the big four firms are great. They're a great training ground. We actually get a lot of employees. Sorry for all the big four partners, but we get a lot of employees from them just because they do such a wonderful job of training. However, I do think there is a little bit of a disconnect. I think they're very compliance focused. I think just because there is a lot of employee churn at generally the bigger firms and things like that they're not getting as deep with clients as I think we could. I think the other thing we saw is, when we were at these big four and doing these individuals with, a whole bunch of zeros at the end of their incomes, we were seeing that, hey, those clients, they were going to their financial advisors, they were going to their family offices, they were going to their estate attorneys first, whenever they had things going on. And I just didn't agree with that. I thought the accountant was a vital part and could really provide value to be at, or at least one of the voices in the center of those conversations. So that's kind of how it started. I just thought there was more value that could be given rather than just kind of like compliance. So I think that's what kind of like started it. And then just over time, we've just tried to find out, like, hey, try and put yourselves in the client's shoes. I firmly believe in that. So like, how can we make it easier? How can we make it better for the clients? Like if I was them, what would I want to see? And then again, like you said at the beginning, we are all CFPs. We don't custody any assets or anything like that. But I do think we come at things a little bit more holistically than kind of like, I'll say the standard accountant that is just looking at tax kind of in a silo. We're trying to think a little bit more holistically, and again, I think it's just resonated really well and allowed us to kind of provide what we think is a little bit more planning orientedness, let's say, to clients than maybe they were getting at their other accounting firm.
It's so funny because I resonate so much with your background at PwC because, I started my career at a private wealth management firm that worked with, nine-figure clients. And I thought, all right, well, maybe the eight-figure clients, corporate executives could benefit from this experience, which, this term, and, I'll admit we have family office on our website. It's like, what does that even mean? But, I like to think about it as like democratizing the family office approach. So for those listening, a family office is typically one family that's wealthy enough to have their own Sam and their own Jeff. No one else gets to share them. It's theirs. And everything is wonderfully integrated, the tax, the wealth, the estate, the insurance. And there's a way where, if you're a corporate executive, you have complexity, but you don't have, you know, crippling complexity. It's not something that can't be blocked and tackled with some sophisticated planning and some articulation through technology. And I really felt so passionate about democratizing that because everybody deserves that approach. And having the right players and the right integration is critical. And then using technology to share that information is so powerful. So let's kind of dive in. Let's talk about our anecdotal corporate executive. And I think, Jeff, what is the first thing that, or at least I'll share with you. The first thing that I'll share with you that when we get a referral is, I'd love to know if this is accurate for you, but it's, Sam, it's great to meet you. I never had a financial advisor before. It's 'cause most of my net worth was tied up in XYZ stock. And I was talking to one of my colleagues who works with you, and he told me the same thing that I did, which was I exercised and sold all of my ISOs on the same day. And I owed $2 million in taxes, and I'm never doing that again. So that's mostly what comes to us. Is that, have you had that before?
Of course, of course. A lot of times, what happens is we come like, and they say, "Hey, they're a little bit early, right?" Like we talk about planning and proactiveness. Like, eh, they come and they say, "Hey, next week, my company's being sold, kind of thing. What can I do?" Right? And, that's like best case scenario. Worst case scenario is like they're like, "Hey, last week my company was sold. I got this pile of money, right? What can I do?" You're so spot on. And it's not that there's anybody doing it wrong. I think it's just different accounting. And what does everybody need in an account, right? Like we like to be a little bit more proactive, but there is a cost to that, obviously, right? So I think we see that a lot. A big thing we see. I'm going to jump around a little bit on you. So incentive stock options. There is a lot of planning that can be done, but it's very much like the earlier you do things, the easier it is, right? It's probably like estate planning too, right? Like the earlier you start, the earlier you do things. Same with financial advising and financial planning, right? Like, hey, the earlier you start, the easier it is, the better you can accomplish, various goals and stuff like that. And it's the same thing here. So, what I'd say to any of these, individuals listening who are like, oh, well, I'm just starting out, I just started at this startup, it's pre-seed, et cetera, et cetera. Like, still just have the conversation. And the answer might be there's nothing to do right now, but the answer might also be like, oh yeah, no, you should do something, and by doing something now you can save, again, we'll get into it, serious, not, maybe not nine figure for tax bills, but significant tax bills for sure.
So maybe it's best to start out with definitions. So let's maybe kick it off with like RSU. What are the
Sure.
tax consequences of being granted RSUs, and what are RSUs?
Sure. So RSUs, or restricted stock units, sometimes they're called restricted stock awards. Sometimes there's restricted stock. So RSU, RSA, from a tax perspective, they're all taxed very similarly. Okay. Now, what is that tax consequence? Usually, those RSUs. Let's stick with RSUs for now. Usually, those RSUs. They're granted with essentially a zero strike price. So, what does that mean? You don't need to pay anything out of pocket to essentially get that share. Okay. Taxation generally, and again, unfortunately, all of these things we're going to talk in generalities. There are always exclusions in tax, right? So, in generality, when those vest, there's a taxation event. Okay. That taxation event happens to be whatever the fair market value. Fair market value can be stock price if it's a publicly traded or company. It can be what's also called a 409A valuation. Okay, so there's going to be some per share price on, let's say, the vesting date, and that difference between that and the strike price, which again is usually zero, that's all going to be ordinary income. Okay, so let's just walk through an example so we're all on the same page. So you get one share, it vests, today. The stock price is $10 a share. You don't have to pay anything. It's a zero strike price. So $10 will be taxed as ordinary income. Okay. That ordinary income, that's subject to all your Social Security, all your FICA taxes, which is Social Security, Medicare. It'll be taxed by the state, federal government. Okay, and then the other thing too is it does have withholdings associated with it. Okay, so you'll actually see it on your W-2 or your pay stub. Okay, and so again, in our scenario, $10. Let's say, okay, they'll withhold, usually 22% for federal, something for Social Security, something for Medicare, something for the state, right? And you'll net whatever is left, right? So you'll end up with like zero point 0.7 a share. Let's just assume I said 10 shares, so you're left with 7 shares, something like that, right? Okay, so now with that said, that's the taxation of RSUs. Here's I'm gonna say like the watch out, right? The big watch out for us is, so if you have RSUs, what you need to be careful of is RSUs have a statutory withholding. So what does that mean? They do a flat withholding of 22% on the first $1 million of essentially RSU type income. Okay. So why does that matter, Sam? Well, if you're in the top tax bracket, that's 37% for federal purposes, right? So if you get $1 million worth of RSUs that vest throughout the year, well, 37, that's taxed at 37%. You only withheld at 22. So a lot of times we see surprises. Okay. So all of a sudden your accountant reaches out on April 1st and says, "Hey, Sam, April 15th, you owe $150,000. That's not a fun conversation." So again, that's just why I am a firm believer in, hey, work with your accountant, get ahead of things, have them run kind of like mock scenarios just to make sure you're aware of that. Okay.
Said it before, said it again, said it a million times. If you ever met me, there are no good financial surprises. You never go to the mailbox and it's that big novelty check from the IRS saying, "We messed up. We owe you 20 years of interest." It's typically in reverse. When you get that share vested, Jeff, then what happens? Can I just sell that stock?
Yeah. So once you get that share, that is your share. Okay. So I'm gonna let's start with public companies, and then maybe I'll quickly go into some private companies, just for anybody with private restricted stock. Okay. So public companies, once you get that share, a lot of times, again, you probably still work for that company, so there may be blackouts. Okay. You may not have the opportunity to sell right away, but then there will be some window where you can transact, or if you have material non-public information, or you're high enough up at the company, you may have to do something called a 10b5-1. Anybody who's not familiar with the 10b5-1, think of it as like you are in the future saying, "Hey, I want to sell shares on this date, at this price," kind of thing, if it meets that price. So it's almost like future limit orders. So again, in some scenario, you will have the opportunity to sell. And again, Sam, I think this brings up a really good point, is a lot of times our recommendation, and again, this is I'm talking in generalities here, right? Talk with your financial advisor, talk with your tax attorney, and all those exceptions, if you will. But in many cases, we'll recommend them to just sell those restricted stock right away. And in the reason being, if I can use an example, again, let's go back to, hey, you got $10, you had $10 vest of restricted stock units, right? You netted $7 because again, they withheld a little bit from taxes. So those $7, you essentially paid tax. So if you turn around and sell those, there's usually minimal tax consequences. Okay. So if I flip it around, I might say that's like me giving you, Sam, $7 in cash. If I gave you $7 in cash, would you turn around and buy your stock? Buy your company stock. Now let's set the example, right? Let's talk in an executive. You may be the breadwinner of your family, right? So your family's income is tied to this company, right? You probably have a whole bunch of stock that is still to be vested, right? So you still have plenty of exposure. And oh, by the way, you might have a material, investment allocation or a concentrated risk in this one stock. So you got all this tied to this one company. Now I give you some cash. Are you going to go and buy that stock?
It's the best way to put it. Typically, the answer is no.
Typically, no. Typically, no. Again, there's a whole bunch of caveats and different scenarios and stuff like that. So that's why, yeah, we are. So restricted stock, again, very, very, very general rule of thumb. Please don't hold me to this. Hey, when that restricted stock sells, a lot of times we recommend, again, taking the cash and diversifying away a little bit.
Yeah, and we can talk later about what happens after that if you hold it, short term, long term capital gains. But for the purposes of the compensation side, let's step up the complexity a little bit. Let's go into the non-qualified stock option.
Okay, non-quals. So the good thing about those, they're actually taxed very similar to RSUs. Okay, but just instead of the vesting being the trigger date, if you will, it's you actually have the option when you exercise. So when you actually exercise a non-qualified option, you will pay tax on the difference between the current share price. So again, either the current share price or this thing called the 409A valuation, which is a per share price less your strike price. Okay. So when I said, hey, RSUs, generally those are zero strike prices. For non-qualified options, there's usually some strike price. Okay. So again, let's do an example. $1 strike price for a non-qualified option. Stock is worth $10. If you exercise that one non-qualified option, that 10 minus the one, you have $9 of ordinary income. And just like an RSU, it's subject to federal taxes, state taxes, Social Security, Medicare, and they will do the same withholding. Again, that statutory 22% withholding. Okay.
So it's almost kind of like a non-qual is like a non-cash bonus, but the difference is you have the ability to control the timing. So from a
Exactly.
tax planning standpoint, right? Let's say you're a highly compensated executive, it's a big year. You live in a state like we're in right now. I should be in Florida, but right now I'm in Massachusetts, right? Now you're looking at 9% if you're over that $1 million threshold. That control of timing is powerful, right? Especially if you're a very highly compensated executive, you might be approaching retirement. A lot of companies allow, maybe some deferral into retirement where you can spread that burden out. This is probably where it comes into planning, right, Jeff? Like you should be working with an advisor, with a tax professional to say, where am I going to be at bracket wise, right? Maybe we can spread this around. Maybe we should see what's coming up in the future. Uh, I imagine that's pretty powerful when we're talking about wealth creation, right?
Definitely.
I will say wealth's going to go three places. It's going to go your family, charity, or the IRS. The
Sure.
order is predetermined. IRS is always number one unless you plan around it.
Yeah, for sure. And I think that's a great. The only thing I do want to emphasize, and again, I think this is where accountants do need to stand up and be like, hey, while I am on the tax side of things, I think a common phrase is the tax tail should not wag like the investment dog kind of thing. So you're totally right. We should try to do our best to maybe defer out non-qualifieds, but on the other hand, if the stock is ripping, let's say, hey, the stock goes, we talked about $10 share price. What if that goes to 100? Maybe at some point we got to kind of look in the mirror and say, you know what, who cares about tax? And not who cares, that's maybe not the right term, but like, yeah, we're going to net a whole bunch after tax. We're going to work with the financial advisor. We're going to hit some of those goals that we checked off in our goal planning setting and stuff like that. So if that's the case, then sometimes we do say, yeah, while it would be nice to, amortize out the tax liability over 10 years, if the stock doesn't always cooperate like that. So in those settings, again, if it makes sense, we're totally fine, kind of like, waiving the tax liability just because we want to maximize after tax, cash.
Yeah, I mean, at the end of the day, the system prioritizes profits, right? You're never going to be paying the IRS more than you're going to pay yourself. You
Exactly.
know, I think the other thing that's paramount, Jeff, I'd love to get your opinion on this, is having a plan, right? There's so much emotion tied into the stock. You're talking for most of these folks, it's 60, 70, 80% of their net worth. Oh, and by the way, you're on the management team believing in yourself, trying to execute your own vision, right? You want to show some self-belief. But I think having a predetermined plan, because whether the stock goes up, down, or sideways, you need to know what you're going to do.
Yeah, I've seen this so often, right? Everybody gets, it's the behavioral finance side of our jobs, I'll say, right? Like the stock is going up, no one wants to sell because they think it's going to keep going higher, right? And they believe in their company, right? Like there's a little bit of worth, if you will, in that setting, which I can relate to. I get, right? But then on the flip side, if the stock goes down, they say, well, it was just at $20 a share, so I don't want to sell at 15 or 10 or so it's a tough thing. So I am a big believer in trying to set plans, trying to do things to mitigate downside risk. And again, it's like clear communication and it's constant communication. This isn't something that's, hey, we get a plan from somebody, we say, okay, hey, here's what we're thinking, and then we set it and forget it for a year or 2 years or 3 years or more, right? It's constant communication. It's checking in on, sometimes weekly, sometimes monthly, sometimes quarterly, just to make sure that, hey, we're still in line, because again, the market waits for no one.
Yeah. And personal life is dynamic, cash flow needs, things change.
For sure.
That's why it's, paramount to make sure that you're in constant communication with your advisory team. So let's get into the fun one,
Yeah.
ISOs.
Yeah. All right, I love ISOs, right? Because this is really where I think an accountant can kind of like provide a whole bunch of value. So ISOs are complicated in all this stuff. I'm saying very general things. There are, just to go back. So private RSUs, a lot of times there are double trigger vesting, so you got to be careful of that. Non-qualifieds, I'm saying there's statutory withholding, but sometimes you can get shares as advisors. So again, I just want to kind of like clarify that I'm talking for the majority of folks, right? If you guys have different situations, again, I think talk with Sam, talk with me. We're happy to get into some of the details of some of the other things. But ISOs here, they're pretty straightforward in that when you exercise. So again, let's go back to our strike price. So again, that's what it costs to own to exercise and pay for and then own that one share of stock. Okay, versus the 409A or share price, is essentially a publicly traded share price. It could be, or a 409A valuation. Okay. So now for non-quals, remember that difference. We had ordinary income taxation. Ordinary income is not fun. There is not a lot that accountants can do, right? Like, yeah, we can do some fun things related to charitables, and real estate has some fun little quirks that you can get. Sam has some investment products that can generate some ordinary losses, but for the majority of things, the ordinary income is tough to offset, right? So ISOs, the big thing with them is when you exercise that share. So again, non-quals, you exercise ordinary income. ISOs, you exercise. There's actually no regular tax consequences, but there is what's called AMT income. So what's AMT? AMT, alternative minimum tax. Okay. So at a very high level, AMT is essentially, it's a separate way of calculating your tax liability. So there's regular tax and there's this AMT, alternative minimum tax. Okay. Both are always ongoing for every tax return. Okay. For every individual tax return, whichever one is higher, okay, whatever calculated tax liability is higher, that's what you pay. Okay. So I only say it like that because a lot of people, they've never dealt with this AMT, right? They've never dealt with this alternative minimum tax because their regular tax is always higher, right? So this AMT tax, it adds some things for income and it disallows certain things for deductions, has different exemptions, different things of that nature. Okay. So again, when you exercise these ISOs, you have this AMT adjustment, but not a regular tax adjustment. Okay. So what does that mean? Well, a lot of times we can exercise some amount of ISOs, okay, and we can bring up our AMT tax liability to just below the regular tax liability. So again, if I go back and I say, hey, you always pay the higher, right? If regular tax is $100, but AMT is $70, well, we could exercise a share. Now we get to 73, but again, we still pay the higher, right? We still pay 100. So then we exercise another share. We get to 76, 78, 82, 85, 90, 95, right? We can get all the way up to $100, right? And really there's no change because again, you pay the higher, right? So you're still paying $100 regardless. And what that does when we exercise those ISO options, we start the clock for long-term capital gain. Okay? So if you then hold those incentive stock options for a full year and a day, now, what happens is you pick up, whenever you sell, you pick up capital gains on the difference between whatever you sell for and your strike price. So, what does this all mean? Let's do an example, okay? So, let's say you have a dollar strike price, okay? When you exercise, it's $10 a share, right? So, $9, no regular tax impact, but we do have an AMT income, okay? And for this purpose, let's just say that doesn't cause any additional tax, okay? Now you go sell when it's $15 a share, right? That $15 minus the $1 strike price, that $14, that's all going to be taxed as a long-term capital gain. Okay. So why do we like that? Well, a whole bunch of reasons. One, lower tax rates. Okay. Highest tax rate is 37% on ordinary income. Federal for capital gains is only 23.8. Okay. So right off the bat, 13% savings, give or take. Figure you're going to get somewhere between a 7 and 17% savings on rate alone. Okay. The other thing, once you get into long-term capital gains, while I said ordinary income, it's tough to get deductions. Once we get over to long-term capital gains, well, now we can work with Sam and his team, and we can do tax loss harvesting. We can talk about qualified opportunity zones. We can look at donating stock. We can look at just a number of different avenues to essentially lower that capital gain that if this was ordinary income, we just wouldn't have those opportunities. Okay.
Yeah, I think a critical piece too for everyone listening is when we talk about exercising those options, right? In the non-quals, right? Typically we just exercise and sell, right? It's all a wash, same day sale, take it all. For this though, we need cash out of pocket to exercise and hold. So I think that's critical when you're thinking about your financial planning opportunities, right? We have your whole lifestyle. Obviously, everybody has their own lifestyle needs for cash flow, but it's critical to think about, all right, like if I don't have the cash to do this, I then lose those opportunities.
Mhm. Yeah, exactly. So this is where, and again, if I can start to get into some of the strategy, right? So what's some of the strategy? Well, we like to exercise earlier in the year rather than later in the year if we can, right? Just because we start the clock a little bit sooner. The other thing we'll do a lot of times is at a bare minimum we'll exercise, as early as we're confident in the stock. Okay, because again, if that spread, I was saying, hey, a dollar strike price in the fair market value is $10, so that picks up $9 of income. But if we had somehow had the foresight to exercise when the fair market value or the share price was $2, well, now we only have a dollar income that we're picking up. So you could theoretically exercise 9 times as many options for the same kind of like AMT impact. Okay, so those are some of the things that, again, if I was working with a client, I'd want to think through that. But again, to Sam's point, I think it's again, we still got to take a holistic view, right? And this is why accountants really need to work with the financial advisors to say, hey, do they want to take cash out of pocket? Again, this goes into concentration risk, right? Do they want to take cash out of pocket or from their bank account and essentially invest in the company to exercise these shares? Again, there's a lot of benefits, but again, we do want to make sure that makes sense for that client.
Yeah, and I think one thing that's important, like I think of like when you exercise those, ISOs and get into that period, I kind of think it as like I'm a big sports fan, is getting into the red zone. You're not quite in the end zone yet. You're at the 20, and there's this period, right, where what happens if you sell that stock, right after you hold it?
Yeah. So if you exercise and then let's say you turn around and sell it, it'll be ordinary income up to the amount that the fair market value less the strike price. That'll all be taxed as ordinary income. So when I say ordinary income, think of like your W-2 and your wages, things like that. Okay. However, it is a little bit different from a non-qualified or an NSO or non-qualified or non-statutory option. It's a little bit different where it's not subject to Social Security or Medicare taxes, and it'll also not have withholding. So again, that's another kind of like, watch out moment where we were talking about, hey, there's a little bit of shortfall in withholding for restricted stock and a little bit of shortfall withholdings in non-qualified options. For ISOs, there's no withholding. So you do definitely want to, again, avoid those surprises, set some money aside, etc. For sure.
Because you could get some underpayment penalties, et cetera, and
Yeah.
not good surprises.
Yeah.
And in that period, from a planning perspective, it gets a little hazy, right? Because you gotta, from our standpoint, it's almost like I'm watching from the sidelines because you can't really hedge the stock. There's rules around that, creating a disqualifying disposition. So you kind of gotta just wait it out until you get in that qualified period, and then that's where the fun stuff happens, right? We can talk about CLATs, CRUTs, DAFs, long, short, direct indexing, using a collar strategy with an option to buy
Yeah.
yourself more time to create a floor and a ceiling, all sorts of things. But these typically right now, let's go back to, our favorite line, simplification is the ultimate form of sophistication, right? Like, how do we simplify when you have, because typically most executives, they have all three of these, right? They've got the RSUs, the non-quals, and the ISOs.
Yeah. Yeah, so it's all working in tandem, right? Um, well, we're going to get a little complicated. We're going to go back to ISOs for a second, right? So ISOs, if you exercise more than that, remember I was talking about a regular tax and an AMT tax, right? If you exercise a little bit more and that AMT grows, so now you are paying more tax out of pocket. And when does this happen? Well, this can happen if you're really bullish on the company. This can happen if you get let go or you leave the company. A lot of times you have 90 days to do something. And if these ISOs are in the money, or essentially the strike price is significantly lower than the fair market value or the 409A or the stock price, you want to exercise those. So that can cause in actual a higher AMT. That AMT that you pay actually turns into a credit most of the time. Okay, so that'll turn into a credit. So it's almost like you're prepaying taxes. So while I don't want to get too into the details there, I did want to at least mention it just because those situations definitely happen where, hey, we actually do think it's worth paying a little bit of extra tax just for some future benefit. Okay.
Where you could be essentially giving an interest-free loan to the government that you're going to get back, but there's benefit for you. And then you can either use that credit back to manage capital gains going forward or Roth conversions or whatever your individualized plan calls for.
Exactly. Exactly. See, Sam doesn't even need me anymore for his clients. He knows all the things to do. Um,
Somebody asked me to explain AMT last week in one sentence. I literally thought of you. I'm like, there's no way I can do this. I need Jeff.
but, but yeah, but going back to, hey, an executive who has all three of those things, well, each bucket is different. So we kind of talked about, if you notice, they have different tax qualifications, right? So if they just need liquidity, well, what's the first thing we're going to sell? We're probably going to sell the RSUs, right? Because there's minimal tax consequences if they have any of those, right? And then next, we're probably, if they just need to exercise and sell immediately, we're probably going to do non-qualifieds after the restricted stock, right? And then if we do some of those, what that does is, and again, now we're getting into this AMT that Sam's just joking around about. We're getting into, well, now that sometimes creates a higher regular tax liability than AMT. So again, if we go back to our strategy, well, anytime regular tax is higher than AMT tax, we will at least look at, do we exercise some ISOs, right? So again, let's just go back to your executive. Hey, he needs some cash or he just wants to diversify out. We, if we have unexercised ISOs, unexercised non-quals, and let's say no RSUs, well, I probably want him to exercise and sell the non-quals because again, we can't really do any other planning, right? It's just a timing thing. So if we're gonna have to sell something, we might as well sell those. But then what we might do is we might turn around and we might actually exercise some ISOs just to start the clock. Because again, if we can exercise those ISOs, wait a year and a day, it opens up a whole bunch of planning opportunities and just can kind of again maximize the cash flow between them.
So speaking of planning opportunities, as we kind of bridge the gap to start talking maybe the startup private side, what about an 83B election? Where does that kind of fall into the mix?
Yeah, sure. So, for those who aren't aware, an 83B election, it essentially, think of it as almost moving up the time to vest. Okay, so let's go back to RSUs. If you remember, I said, hey, when RSUs vest, okay, when they fully vest, there's a tax consequence. Okay, now, that tax consequence is based on whatever the fair market value is at that time. So, whatever the share price is at that time of vesting. Okay. So, what an 83B election does is it just moves it up. Okay. So, you do have to do it within 30 days of grant. Okay. And that's the only time. So, if you miss that, you're out of luck. Okay. So, you do have to do it pretty quick. But what this does is it pulls everything and says, hey, you know what? I want to elect to include all of the vesting today. And what that does is twofold. One, it starts the clock today. Okay. And we'll get into why that's important. Okay. It's important for long-term capital gain status. It's important. It's important for QSBS, or sometimes called qualified small business stock, sometimes called 1202 stock. Okay. So it's important for starting that. And then it's also important because the value of the company, if you believe in this company, a lot of times you think that company is going to be valued higher in 4 years or 3 years or 2 years, whenever the vesting occurs. You think it's going to be higher. So you'd rather pay tax today on a smaller spread. Okay. So again, what does that look like? The spread, a lot of times, it might be zero, right? Like if you just started a company, your company is worth nothing, right? It's just an idea in your
Sometimes less than nothing.
sometimes less. Sometimes there's debt, right? So it's worth nothing. So if you get a whole bunch of shares and let's say there's vesting associated with it for some reason, a lot of times you'll make that 83B election to say, okay, I want to pay all the tax today on that spread. Well, lucky for us, that spread is zero, right? You pay zero to exercise, it's worth zero. Okay. So that again, that starts the clock for all the different investings, whether it's long-term capital gains or qualified small business. It starts the clock, and we essentially pay no tax. Okay, or there's no income pickup, I should say, on it. So 83B elections are wonderful. You can also do 83B elections if your company allows early exercise of options. Okay, so there's also an 83B election that you can do there. Not as common as restricted stock, but definitely we see that from time to time for sure.
Got it. Especially in the startup world, if you can kind of get that clock ticking, because sometimes there's just cash offers, right? And
Definitely.
now you're looking at long-term capital gains versus short-term, and that's a significant difference.
Again, and I think an important thing is flexibility here, right? So again, the earlier you start to plan, the earlier you engage someone like Sam, the earlier you engage you an accountant, like just the sooner you can do some of these things, it just allows a lot of flexibility, right? So if we have exercised ISOs and exercised non-quals and some RSUs or whatever, hey, now we can do, a whole bunch of different things to really maximize tax. If we haven't done any of that, sometimes it's just, yeah, we need cash, exercise and sell, and it's the worst tax treatment.
Let's go to that section 1202 stock. That's what gets me really excited. We've had many mutual clients where we're like, me, you, the attorney, we're talking about corporate structure. We're like, hey, you can do this. Or a lot of clients consulting. A lot of clients are consulting, and we bring in the attorney. The attorney says, hey, you know what? You don't have to pay us $1,000 an hour. We'll just take 0.5% of equity in section 1202. We've had a couple home runs there.
Yeah, yeah. So 1202, also called qualified small business stock. If you ever hear QSBS, they're all talking about this same thing. So what is this? This is stock, and it's original issuance stock. So it can't be like, hey, you bought it from on the secondary market or anything like that. It does have to come right from the company. The other thing I want to say is it's stock. Okay, so I've unfortunately seen this before where people have options and they think, well, I got these options when this company was nothing, so I have qualified small business stock. Unfortunately, no, you have to exercise. You have to own the actual stock kind of thing. Okay. So 1202 QSBS, it has to be from a C Corp. Okay. So all of those partnerships and LLCs, LLC is such a great structure, flexible, can do a whole bunch of things, but can't get QSBS. Okay. So C Corp structure, original issuance, it has to be an active business. Okay. And it has to be a qualified business. So it can't be, health, law, engineering, accounting, financial services. They don't like any of us, Sam. Okay.
No,
Farming, you know.
no,
So any of those are out. You can't have those. But so generally, where do we see them? We see them in tech, biotech, software, things of that nature. That's the main area where we see this QSBS. And again, what it does is if you can, I'm gonna talk about the old rules first, okay? Because actually they were just changed last year with the passage of the OBBA. So the old rules were, hey, if you acquired this stock when the company was 50 million or less of gross assets, okay? So if you acquire that stock, you hold it for 5 years, you get up to a 10 million gain exclusion. Okay. It's technically 10 million of gain exclusion or 10 times basis. I would say 99% of the time it's the 10 million gain. So again, let's go back to our early examples. Okay. Let's say you exercise these ISOs way back when, right? They qualify for qualified small business stock treatment. Your company IPOs, everybody is ecstatic, right? You're now in a trading window. You can sell everything for $10 million. Guess how much tax you pay at the federal level? Zero. You pay zero. You hold that for 5 years, $10 million of gain, you pay zero tax. So just an amazing thing. Again, the incentive that Congress and IRS did was, they want people to invest in these type of companies, right? So up to a 10 million of gain, it's a huge thing. So again, 5-year hold. So pre July 4th, 2025 companies. Okay. So before July 4th, 2025, if you get the stock while it's under 50 million of assets, it's from a C Corp, it's direct from the company. There are some redemption rules that we got to be careful of. But assuming you hit that, you 5-year hold, $10 million of gain, fully excluded, and a lot of states follow it too. Okay, really important, really important. Again, I'm gonna bang this over the head. This is why you start planning earlier. This is why you reach out to the Sams of the world. This is why you reach out to your accountant and talk through things when you get them, not just when there's a transaction coming in a week kind of thing.
Yeah, what I think I would tell folks too, because they never see this event coming, right? For all the clients that we have, it's like, oh my gosh, this is like I've never thought this would happen. Ju- do yourself a favor and track them, right? All the crazy spreadsheets that we have to do going back, like highlighting, tracking the stock, getting the lots. It goes to computer share and then Fidelity, and it's a whole disaster. Just do yourself a favor and make sure you're kind of tracking those things to save yourself, 30 hours of,
Oh, for
you know,
sure. Oh, preach.
but now that the 1202 is even better, right?
12 2. So yeah, let's talk about new. So new companies. So those are after July 4th, 2025. So instead of 50 million of gross assets, okay, now companies can have up to 75 million of gross assets. So what does that mean? It just allows for a little bit longer like seeing window, let's call it. Okay. And that's big because again, for ISOs, that's still cash out of pocket, right? So like we want to make sure that this company or whatever this stock that you're about to exercise and own has some runway and has some kind of like upside to it, right? So again, that 50 million, the company can have up to 75 million of gross assets, and then it's actually going to be indexed to inflation, so it'll continue to climb after 2026. Okay, and then also while previously it was a 5-year and it was a hard cliff, right? So if you got 4 years and 364 days, and unfortunately I've seen this, I've seen people were 4 years, they were 3 months away from hitting 5 years, and the deal closed and they didn't get it. So they had to pay tax on 23.8% on all of it, right? If they had waited 3 months, they would have got full exclusion. So now under the new rules, if you hold it for 3 years, you get a prorated, you get 50% gains exclusion. Okay, 4 years you get 75% gain exclusion. 5 years, again, you still get the 100. So they've tiered it in. They've made it a little bit easier to get as far as again increasing the cap that the assets that the C corp can have. So again, really good things only because there was some talk about getting rid of some of this stuff. So again, to keep this was really important and just a really good planning opportunity for a lot of people.
And higher dollar amount too, right?
And oh, I'm sorry, yeah, and 15 million of gain. So before you could do 10 million of gain per issuer exclusion. Now you can do up to 15 million of gain per issuer.
And this is also where for wealthy families, the planning can get really enhanced, right? Like we've done clients where they instead of taking, as mentioned, cash, they take equity, and then we just take that equity and put it right into a slat or an irrevocable trust, and now you got the double tax win. You got the 10 million or 15 million estate, tax free, and it grows estate tax free. Like that's kind of the holy grail of planning, and we've had those. We've had many of those.
Exactly. So a lot of these founders that we work with, they have more than 15 million of stock that Sam's talking, that all qualifies, right? They have 30 million, right? So you can do some of these strategies that actually expand on that 15 million. You can double it. Sometimes you can triple it. In just really a lot of planning that can go into it. So a lot of times they call that, QSBS stacking or 1202 stacking. So that's definitely something that can be done and should be looked at for sure.
And maybe when this clip gets posted, it can get picked up into my LinkedIn algorithm that just hits me with QSBS stacking all day because those are the weird things that I talk about when I'm at home. All right, Jeff. So we've covered a lot. We've covered RSUs, ISOs, non-quals, 1202 stock, 1202 stacking. Are we missing anything for corporate executives? Is there any favorite planning topics that you like? I mean,
Yeah, I mean, I think we've hit on a lot of stuff, as far as the planning side of things. I think it's thinking about kind of like next gen for those, next generation kind of stuff, working with trusts, We talked about 1202 stacking, how charitably inclined. All of this does have to work. A lot of times these are executives, these are public figures. So a lot of times we got to be careful of general counsel and market appearance about selling. So again, all of this stuff it's there's no one size fits all. So maybe at the end of the day, what does this all mean? It's again, it's constantly working with the professionals that you work with and keeping them updated on your situation. It just to really maximize it, because again, it's so personalized, right? I can have the same company, the same stock, but just two different situations, and I'm gonna have two different recommendations, right? So I think it's really paramount to again continue to keep that conversation at the forefront and work with people who frankly know what they're doing.
Jeff, this was a great way to end my Friday. I'm all jacked up on Diet Coke and iced coffee. I'm feeling good.
Same,
I'm feeling
right?
like
Oh, this is a blast. I'm always down to jam with you. This is so much fun.
well, as we end every episode, Jeff, the floor is yours, and I'll preface this by saying Jeff is a fantastic tax advisor, but it's not just Jeff, it's his team. Jeff is my tax advisor. He's our company's tax advisor. If you're interested in talking to Jeff, reach out to me, reach out to Jeff directly. But as you ended, I know Seaport Partners is always working on cool things. The floor is yours. You can tell listeners whatever you want, whatever you're doing this weekend, whatever's going on at Seaport Partners. But you can round us out here, Jeff.
Yeah, sure. So I will say we've been very fortunate. Again, like it's very much a team thing. So we have a wonderful team at Seaport. They do just a really good job. We're very familiar with this. So again, we're not the right fit for everybody. Again, like I said at the beginning, you got a big, multinational corporation, things like that. We're not the right fit, and we're okay telling you that. We're a big believer in, again, Sam at the beginning mentioned kind of like democratizing the services, right? And we firmly believe in that. You should work with the best financial advisor like Sam, and you should work with the best tax accountant who knows whatever tax situation that you have. So I think we've really owned into that kind of thing. We know what we're good at. We know we're really good at that individual and that kind of like that person who could use some planning. And especially again, anytime there's equity compensation, there's planning to be had, and like, we can show millions of dollars in savings and stuff like that. So anytime we can do that, I think that's really good. And again, it's really a testament to my team. Again, they do an absolutely wonderful job. Again, a big thing for us is just like, hey, we want to be better than any other firm we know, every day in every interaction, and really they live by it, kind of thing. I think the other thing that they do and we do really well is, again, we are CFPs, right? Like I highly encourage that throughout my firm. And again, it just allows us to look at problems a little bit more holistically. I think also because of how we do business, how we really try and open it up and work with the other professionals rather than kind of like staying in our silos. I think we do a really good job of kind of like learning from others. Like I mentioned, like, hey, I've learned so much from Sam and his team. And I've been able to take that to other individuals and stuff like that. Almost like a copy and paste kind of thing. And it's just allowed us to really be holistic and kind of have that holistic lens rather than coming at things, from only a tax perspective. So I can't say enough good things about my team. If we can help anybody, again, we're always happy to help. It doesn't have to be a full-on engagement. It could be a one-off question and things like that. Again, I'm a big believer in what you put out there, comes back to you and stuff like that. So if we can help, again, we're always open to answering those questions.
And help you have many of folks, and me personally, great team. We can give a shout out to Brittany for always helping me unlock my portal when I inevitably forget my password. Well, with that, Jeff, thank you so much for sharing your knowledge. Like I said, if you're interested in reaching out to Jeff, if you have questions, reach out to us. And I'm wishing everybody a wonderful day. Thanks for joining us.
Thanks for listening to the G360 Wealth Podcast. If today's episode gave you something to think about or act on, share it with someone who might need it. Don't forget to hit subscribe so you're always in the loop. If you want to learn more about how we help families like yours simplify and grow their wealth, visit us at generationcapitaladvisors.com. Until next time, take care and keep building. The information covered and posted represents the views and opinions of the guests and does not necessarily represent the views or opinions of Generation Capital Advisors. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. Investment advice offered through Integrated Partners, doing business as Generation Capital Advisors, a registered investment advisor. The information in this material is for general information only and is not intended to provide specific advice or recommendation for any individual. Integrated Partners does not provide legal, tax, or mortgage advice or services. Please consult your legal or tax advisor regarding your specific situation. All investing involves risk, including loss of principal. No strategy assures success or protects against loss.